Have you ever wondered what's really going on in the minds of Wall Street's biggest players? It's not just guesswork. Not at all. Behind every single major investment decision, there's this powerful theory, a real battle of ideas about risk, reward, and, yeah, even human psychology. Today, we're going to pull back that curtain on the theories that decide how billions of dollars move around the world. So, how do they do it? I mean, really, how do the pros figure out where to park all that money? Is it a pure science, all about crunching the numbers? Is it more of an art, playing hunches? Or is the whole thing just one big, high-stakes gamble? Well, let's dive in and find out. All right, so our story really starts with this dream, a dream of pure, cold rationality, the hunt for a perfect mathematical formula that could master risk and just max out returns. This is where a big idea called modern portfolio theory, or MPT, enters the picture. Now, to get your head around MPT, you first have to understand that there are basically two flavors of risk. First up, systematic risk. Just think of this as the big one, the market-wide risk you just can't dodge. It's a recession, a global crisis, something that hits everybody. You can't just diversify this away. And then you have unsystematic risk. Now, this is the stuff that's specific to just one company or maybe one industry. A CEO makes a bad decision, a new product totally bombs, a factory has a fire. This is the kind of risk you can actually do something about. So here's the billion-dollar question. How do you handle that company-specific risk? Well, the answer is probably the oldest advice in the book. Don't put all your eggs in one basket. On Wall Street, we call that diversification. And what's amazing is just how well this works. I mean, take a look at this curve. The theory shows that just by adding, say, 15 to 20 different stocks from a bunch of different sectors to your portfolio, you can pretty much wipe out most of that unsystematic risk. It's incredible. The risk that's left over? Well, that's just the market risk we all have to deal with. And this leads us to the holy grail of modern portfolio theory, the efficient frontier. What this cool-looking curve shows you is basically the sweet spot. For any amount of risk you're willing to take, there's a point on this line that gives you the absolute best possible return. So, according to the theory, a perfectly rational investor, they would never, ever pick a portfolio that's below this line. Why would you? Okay, so we've diversified, we're managing risk. Great. But that brings up the next huge question. What's the right price for that risk? I mean, how much extra return should you demand for taking on more of it? To answer that, we need a new tool. We've got to talk about something called beta. All beta does is measure how sensitive a stock is to what the overall market is doing. So a stock with a beta of 1, it just moves right along with the market. But a beta of 1.5? Whoa, that's 50% more volatile. It's going to swing way higher when things are good and drop a lot harder when they're bad. And that little number, beta, is basically the engine inside the capital asset pricing model, or CAPM. It's this really famous formula that helps figure out the return an investment should give you. It was kind of seen as the peak of that whole rational dream. But just as the math whizzes were perfecting their models, this totally radical new idea popped up. An idea that made people question the whole thing. What if all this hard work to find the perfect portfolio was completely useless? And this is where the efficient market hypothesis, or EMH, comes in. Now, this is a hugely controversial theory, and the idea is simple, but wow, it's a big one. It basically argues that a stock's price already reflects all the information that's out there. And if that's true, there are no bargains. There's nothing underpriced to find. The game is already over before you start. Now, EMH comes in 3 different flavors, and each one gets a little more extreme. The weak form just says you can't predict the future by looking at old price charts. Okay. The semi-strong form says all public info, like news, earnings reports, is already baked into the price. Then you get the strong form, which is the most extreme. It says even private, insider information is somehow reflected in the price. So you might be thinking, is this just some wild academic theory? Well, here's the thing. Proponents point to one really powerful piece of evidence. Year after year, the huge majority of professional fund managers, the people paid millions to beat the market, they just don't. They fail to do it consistently. It's a tough pill to swallow. But hold on. If markets are so perfectly efficient, if everything is so rational, why do they feel so, human? And this brings us to the glitch in the machine. The one variable these perfect models kind of forgot about: us. I mean, Think about it for a second. If the efficient market hypothesis is 100% correct, how on earth do you explain something like the dot-com bubble or the 2008 financial crisis? These things just seem to fly in the face of pure, cold, calculated logic, right? And this is where behavioral finance steps in. It doesn't toss out the old models, but it adds this crucial, messy layer: human beings. It says we are not the rational, calculating machines that the early theories assumed we were. We follow the herd, we get stuck on random prices, we're way too confident in our own abilities, and maybe most important of all, we hate losing. And the power of that fear is just stunning. A field called prospect theory actually put a number on it. It found that the psychological pain of losing a dollar feels about 2.25 times stronger than the pleasure you get from gaining a dollar. Think about that. This loss aversion makes us do crazy things like sell our winners way too early and hold on to our losers for far too long. So what you have is this epic clash of ideas: the perfectly rational, efficient market on one side and our predictably irrational minds on the other. And that very battleground is what created the two great warring philosophies that define how we invest today. So in one corner, you've got passive investing. This comes straight from the efficient market hypothesis. The logic is simple. If you can't reliably beat the market, then just buy the market. Use cheap index funds and just go along for the ride. But in the other corner, you have active investing. This philosophy comes from behavioral finance. It believes that because people are irrational, they make mistakes, and they create mispricings. And a smart, disciplined investor can take advantage of those mistakes. But the story doesn't stop there. In just the last few years, a whole new, really powerful dimension has been added to this whole decision-making process. And it goes way beyond just risk and return. And that's the ESG framework. See, more and more investors aren't just asking, what's my return? They're asking, what is the impact of my money? They're looking at a company's environmental footprint, its social impact, how it treats its workers and communities, and its corporate governance. Is it run well? Is it ethical? This adds a whole new layer of complexity on top of everything else we've talked about. Which brings us to our final question. When you're making decisions, when you're measuring performance, what's really driving the market? Is it the beautiful, elegant logic of a mathematical model? Is it the predictable, sometimes chaotic irrationality of the human crowd? Or is it becoming more about the values and the principles you want your money to represent? At the end of the day, the answer to that, well, that's what defines you as an investor.